Across the United States, a major shift is reshaping the business landscape. For decades, corporate-owned chains dominated expansion. Big brands built thousands of company-operated locations, controlled every detail from headquarters, and scaled as fast as possible. But today, that model is slowing down. Corporate-owned stores are expanding more cautiously, while franchise-run locations are growing faster than ever. In industry after industry, franchises are not just keeping pace, they're pulling ahead. And the momentum behind this shift is stronger than most people realize. To understand why this is happening, you first have to look at today's business environment. Running a corporate-owned store has become significantly more expensive. Companies face higher borrowing costs, rising labor expenses, elevated construction prices, and tougher operating conditions overall. Every new corporate location requires millions of dollars in investment and months of planning and staffing. When interest rates were low and growth was cheap, corporate chains could absorb those costs. But in today's economy, the financial risk is far greater. Franchises solve that problem instantly. Instead of the company funding every new location, local franchise owners invest their own capital to open the store. That means the brand grows its footprint without taking on extra debt, without absorbing all the construction costs, and without carrying the full weight of day-to-day operations. The brand still gets the recognition, the royalties, and the market presence, but the financial burden is shared. This makes franchising the more stable and sustainable growth model in an era where cost efficiency matters more than ever. But finances aren't the only reason franchises are rising. One of the biggest advantages of franchising is local ownership. A franchise owner has something that no corporate manager has: personal investment. It's their money, their livelihood, and their reputation on the line. Because of that, franchise owners tend to pay closer attention to details. They show up more. They care deeply about customer service. They adapt quickly when something in the neighborhood changes. And when the owner is present, employees often feel more supported and connected. Corporate-owned chains simply can't match that level of personal accountability at every store. With thousands of locations spread across the country, performance varies widely. Some stores do well, others struggle, and many suffer from leadership turnover and inconsistent local management. Franchises, on the other hand, often outperform their corporate counterparts because the owner is locked in, committed, and motivated to keep the business running at its highest level. Another major factor behind the franchise boom is market saturation. Most major cities are already filled with corporate-owned chains. The best retail spaces are taken, and expansion in top-tier locations becomes expensive and highly competitive. But franchise owners are willing to go where corporate chains often won't. Smaller towns, suburban corridors, rural communities, and overlooked neighborhoods. These areas aren't always profitable enough for corporate expansion, but they're perfect for a local owner who understands the community. This ability to expand into underserved markets gives franchises a massive advantage. It allows brands to grow in places they never would have reached on their own. And because franchise owners have a personal connection to their area, they often know exactly how to tailor operations, staffing, and marketing to local demand. The labor market also plays a role. Managing large teams of hourly employees nationwide has become increasingly difficult for corporate chains. Turnover is high, training is costly, staffing is unpredictable. But franchise owners are on the ground. They know their employees, they understand their customers. They can adjust schedules quickly, handle issues directly, and maintain a stable team because they're part of the community. That kind of flexibility is hard to duplicate at a massive corporate scale. There's also a surge in investor interest. More Americans are looking for small business ownership, and franchising provides a structured, lower-risk path compared to starting a business from scratch. Investors want stability, proven systems, and recognizable brands. Franchises offer exactly that. The demand for franchise opportunities has grown, and companies are responding by opening more franchise locations instead of corporate stores. It's a strategy that reduces company risk while tapping into strong buyer demand. Meanwhile, many large brands are taking an even bigger step: refranchising. This is the process of selling corporate-owned stores to franchise owners. It allows companies to reduce operating costs, streamline the business, and focus on brand management instead of store-level operations. Refranchising has become common across fast food, retail, automotive services, and fitness. It's a way for brands to become leaner, more predictable, and more profitable without shrinking their presence. Technology is accelerating the franchise model even further. Modern franchise systems use advanced software for training, scheduling, marketing, inventory, and performance tracking. This allows franchisors to manage large networks without adding layers of bureaucracy. 20 years ago, overseeing thousands of franchise locations was far more complicated. Today, with real-time analytics and standardized platforms, companies can guide and support franchise owners efficiently and consistently. Consumers are also shaping this trend. Most customers don't think about whether a business is corporate-owned or franchised. They simply feel the difference in service. Franchise-run locations often operate with more energy, more personalization, and more pride. A store where the owner is regularly present tends to run better, stay cleaner, and maintain stronger relationships with regular customers. That difference translates directly into customer loyalty. Another reason franchises are pulling ahead is speed. Corporate systems move slowly. Decisions pass through multiple teams, departments, and executives. Even small changes can take months. Franchise owners can pivot instantly. If the community changes, if a competitor appears, or if demand shifts, franchise owners can respond the same day. In a fast-changing economy, speed is a massive advantage. When you look at everything together, the financial environment, the rise of local ownership, investor demand, market expansion, operational pressure, and evolving consumer expectations, the trend becomes clear. Franchises are rising because they fit today's economic landscape better than corporate-owned chains. Corporate stores aren't disappearing, but they're no longer the default growth engine for major brands. Franchises offer stability without debt, growth without heavy risk, and performance without constant oversight. As long as costs remain high and markets remain competitive, franchising will continue to be the expansion model that moves fastest. And over the next decade, you can expect even more brands to shift toward franchise-first strategies. More corporate stores will become franchise locations, more entrepreneurs will enter franchising, and more industries, from healthcare to education to home services, will adopt franchise models that give local owners the power to grow. Because in today's business world, the strongest growth isn't coming from the biggest corporations, it's coming from the local owners who bring national brands to life, one community at a time.